A math prodigy with an MIT pedigree convinced Wall Street, politicians, and millions of everyday people that his exchange was building the future of finance. At its peak, FTX was worth $32 billion, and its founder was hailed as a visionary. Then, in just days, the empire crumbled, revealing billions missing and the world's most trusted crypto brand built on dangerous secrets. How did trust turn into one of the largest collapses in financial history? And who saw the red flags that others ignored? Sam Bankman-Fried's rise began long before FTX. At MIT, he stood out for his sharp intellect and restless curiosity, often skipping lectures to solve complex math problems on his own. After graduating, he joined Jane Street Capital, a Wall Street trading firm known for its demanding environment and quantitative edge. There, Bankman-Fried earned a reputation for bold trades and an appetite for risk, traits that would define his approach to crypto years later. But it was not just technical skill that set him apart. Bankman-Fried wrapped his ambitions in a public devotion to effective altruism, promising to give away most of his fortune to high-impact causes. He spoke at conferences about maximizing good in the world, and his signature look, disheveled hair, cargo shorts, untied sneakers, became part of the myth. Media profiles painted him as a new breed of billionaire, eccentric, driven, and guided by a moral code. This image proved magnetic. Venture capitalists, celebrities, and politicians lined up for meetings, eager to back a founder who claimed he was building not just wealth, but a better future. His willingness to talk openly about risk, regulation, and ethics won over skeptics and fueled a sense of trust. As FTX gained momentum, Bankman-Fried's persona became inseparable from the exchange itself, drawing in investors who believed they were betting on a visionary, not just another crypto startup. Few questioned the story. The trust premium he enjoyed would shape every decision and blind many to the dangers gathering just out of sight. Alameda Research began as a nimble trading outfit, chasing tiny price gaps across global crypto markets. Early on, the firm thrived on arbitrage, buying Bitcoin in one country and selling it for more in another, repeating the cycle at scale. But as the easy profits dried up and competition intensified, Alameda's strategy changed. The firm pivoted to riskier directional bets, often using borrowed money to amplify potential gains. Leverage became a defining feature. By 2021, Alameda was routinely borrowing billions, sometimes at ratios that would make even seasoned Wall Street traders uneasy. Caroline Ellison, who joined as a trader and quickly rose to chief executive officer, played a central role in managing these positions. Known for her quiet intensity and comfort with high-stakes math, Ellison oversaw a portfolio that increasingly relied on FTX for liquidity. When outside lenders grew cautious, Alameda tapped deeper into FTX's resources, blurring the lines between what belonged to the trading firm and what belonged to the exchange's customers. Internal risk controls were minimal. Alameda's trading engine could take on huge exposures with little oversight, and losses were papered over with fresh loans or new collateral arrangements. As the bets grew larger, so did the pressure. Alameda's balance sheet became a patchwork of volatile tokens and borrowed funds, much of it propped up by assets whose true value depended on the continued health of FTX. The firm's appetite for risk seeded vulnerabilities that would later threaten the entire empire. Inside the Bahamas headquarters, the mood remained confident, at least on the surface. FTX did not just enter the crypto scene, it exploded onto it. In 2019, Sam Bankman-Fried and his team launched a trading platform that promised speed, complexity, and a user experience tailored for both retail traders and Wall Street professionals. Within months, FTX rolled out a dizzying lineup of products: Bitcoin and Ethereum futures, leveraged tokens, options, prediction markets, and even tokenized stocks. Traders flocked to the platform, drawn by its low fees, deep liquidity, and the sense that this was the place for serious action. The company's ambition did not stop at trading. FTX signed a $135 million deal for naming rights to the Miami Heat's arena, splashing its logo across NBA courts and concert stages. Super Bowl ads followed, starring Tom Brady and Gisele Bündchen. Formula One cars, Major League Baseball umpires, and esports teams all wore the FTX brand. In a matter of 2 years, FTX transformed from a little-known exchange into a household name. By early 2022, The company's valuation soared to $32 billion, backed by blue-chip investors like Sequoia Capital, SoftBank, and Tiger Global. Everywhere, headlines hailed FTX as the future of finance. The exchange's sponsorships and celebrity partnerships drowned out doubts, projecting an image of stability and trust. For many, the speed and scale of FTX's rise seemed to confirm the genius of its founder and the promise of crypto itself. What no one saw, at least from the outside, were the hidden vulnerabilities beneath the surface, waiting to be exposed. FTT, the native token of FTX, sat at the center of the exchange's financial machinery. On paper, it offered trading discounts and perks to users. In practice, it became the backbone of a fragile collateral system. When FTT launched in 2019, Alameda Research claimed between 60 and 70% of the total supply, with the rest tightly controlled by FTX insiders. On-chain analysis later revealed that nearly 80% of all FTT tokens were either held by FTX itself or locked in contracts benefiting Alameda. This concentration meant the token's market price was less a reflection of organic demand and more a product of internal maneuvering. Alameda began leveraging its FTT holdings to secure billions in loans from outside lenders. But the market for FTT was thin. If Alameda ever tried to sell a meaningful portion, the price would plummet, instantly erasing the value on its balance sheet. To keep up appearances, Sam Bankman-Fried and Caroline Ellison agreed to list FTT as a separate asset on Alameda's books, masking the risk that came with holding so much of a token with little real-world liquidity. As crypto markets faltered in 2022, Alameda deposited billions of dollars worth of FTT onto FTX, using it as collateral for emergency loans. This created a closed loop. FTX minted the token, Alameda borrowed against it, and both relied on the price staying high. The entire structure depended on no one testing the true value of FTT. If confidence cracked, the collateral engine would seize, exposing a multi-billion-dollar hole that no amount of accounting could hide. Gary Wang, the chief technology officer at FTX, wrote a piece of code that would quietly change the fate of billions. Buried in the exchange's engine was a line granting Alameda Research a privilege no other trader enjoyed: the ability to run a negative balance. For most users, dipping below required collateral triggered instant liquidation and locked accounts. But for Alameda, a hidden flag known internally as allow negative let losses pile up, unchecked, no matter how deep the hole became. This exception did not appear in public documentation. It was not flagged in audits or risk reports. Only a handful of insiders had access, and all were close to Sam Bankman-Fried. Nishad Singh, director of engineering, helped oversee the codebase. The logic itself was simple. If the account belonged to Alameda and the flag was set, the system skipped every safeguard. Alameda could withdraw, trade, and borrow far beyond its posted collateral, tapping directly into the pool of customer funds. Investigators later traced the privilege back to direct instructions from Bankman-Fried, relayed to Wang and Singh. There was no formal review, no oversight. Forensic analysis of the ledger showed Alameda's balance slipping billions into the red, sometimes as much as $65 billion in available credit, without triggering alarms. The loophole stayed in place for years, invisible to outside investors and regulators. Only a chance discovery by a subsidiary's engineers would later bring the secret to light, setting off a chain of internal warnings that went unheeded until it was too late. Spring 2022 brought an unexpected discovery inside FTX's own walls. Engineers at LedgerX, a subsidiary of FTX operating under stricter US regulations, stumbled across a troubling anomaly while reviewing the exchange codebase. Buried in the logic, they found that Alameda Research enjoyed special privileges, most notably the ability to sustain negative balances without triggering liquidation. For every other account, dipping below required collateral meant instant shutdown. For Alameda, the system simply looked the other way. Alarmed, the LedgerX team raised concerns in internal Slack channels, documenting their findings and escalating the issue to risk managers and senior engineers. Screenshots and logs captured their questions. Why was Alameda exempt? Who approved this? The answers never came. Instead, the warnings were quietly dismissed. Nishad Singh, director of engineering, acknowledged the loophole but gave no indication of plans to fix it. The code stayed in place, untouched. Attempts to push for remediation met resistance. Julie Schoening, head of the LedgerX engineering group, was dismissed from her role soon after the discovery, officially for unrelated reasons, but colleagues suspected her outspokenness played a part. Other engineers were told to drop the matter. By late summer, the issue had faded from internal discussion, but the risk remained unaddressed. The chance to stop the bleeding before disaster struck was lost, buried beneath layers of silence and denial. On November 2, 2022, a single article sent shockwaves through the crypto world. CoinDesk published a leaked balance sheet from Alameda Research, exposing that much of its reported assets were tied up in FTT, the same token minted by its sister company FTX. The numbers look shaky, with billions in FTT, little real liquidity, and a tangled web connecting the two firms. Confidence, already fragile after a year of crypto turmoil, cracked. Within hours, whispers of insolvency turned into shouts across social media and Telegram channels. Traders, spooked by the revelation, began pulling funds from FTX at a pace the exchange had never seen. On November 6th, Binance CEO Changpeng Zhao, known as CZ, announced that Binance would liquidate its entire FTT holdings, worth around $580 million. The move hit like a starter's pistol. A digital bank run was underway. FTX's withdrawal queue swelled with requests. In a single 72-hour span, customers demanded more than $6 billion back. On-chain data showed wallets draining at a rate of hundreds of millions per hour. Inside FTX's Bahamas headquarters, the atmosphere turned frantic. Sam Bankman-Fried and his inner circle scrambled to reassure the public, tweeting that assets are fine and FTX is solvent. But behind closed doors, staff watched balances plummet. The war room buzzed with urgent calls and signal messages, searching for rescue capital, debating whether to freeze withdrawals, and weighing the risk of total collapse. As withdrawals accelerated, FTX's secret vulnerabilities came into view. The exchange had quietly funneled billions in customer assets to Alameda, leaving a hole that could not be filled. Every hour, the gap widened. Attempts to raise emergency funding failed. Even the promise of a buyout could not stop the bleeding. On November 8th, FTX announced a tentative deal for Binance to acquire the non-US business. For a brief moment, hope flickered, but after a day of due diligence, Binance walked away, citing mishandled customer funds and regulatory concerns. The exit was swift and final. By the evening of November 8th, FTX halted withdrawals entirely. The platform that once handled billions in daily trades was frozen. Customer balances vanished into a black hole of uncertainty. The collapse, triggered by a single leak and accelerated by a wave of panic, was complete. In less than a week, FTX went from industry titan to insolvent, leaving billions in customer funds unaccounted for and the entire crypto ecosystem in turmoil. John J. Ray III arrived at FTX's Nassau headquarters on November 11, 2022. Stepping into a scene he would later describe as worse than Enron. The new chief executive officer, known for cleaning up some of the largest bankruptcies in American history, found no reliable list of bank accounts, no record of employees, and almost no trustworthy financial statements. In sworn testimony, Ray told Congress, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here." Ray's forensic team began piecing together what remained. They uncovered a maze of shell companies, luxury real estate deeds, and a tangle of wire transfers to political campaigns and venture investments. Billions in customer funds had been routed through Alameda Research with little documentation and almost no oversight. Internal spreadsheets were riddled with errors and omissions. The exchange's assets, once valued at $32 billion, now seemed more like a mosaic of missing money and IOUs. The criminal investigation moved quickly. Within weeks, United States prosecutors charged Sam Bankman-Fried with wire fraud, conspiracy, and money laundering. He was arrested in the Bahamas and extradited to the United States. As the trial began, the government's case relied heavily on testimony from FTX insiders. None more important than Caroline Ellison, Alameda's former chief executive officer. On the witness stand, Ellison described how Alameda borrowed unlimited sums from FTX using customer deposits to cover its trading losses. She admitted to falsifying balance sheets to hide the shortfall and spoke openly about the pressure she felt as the losses mounted. In private diary entries later read in court, Ellison confessed to remorse, guilt, and fear as the empire unraveled. Gary Wang, FTX's chief technology officer, also took the stand, confirming that the code giving Alameda special privileges was written at Bankman-Fried's direction. Nishad Singh, director of engineering, testified about the lack of internal controls and the deliberate concealment of Alameda's negative balances. Their admissions painted a picture of a company where a handful of people controlled billions, unchecked by auditors or risk managers. The verdict arrived in November 2023. After weeks of testimony and thousands of pages of evidence, the jury found Bankman-Fried guilty on all counts. The conviction brought a measure of closure for creditors and customers, but the work of Ray's team continued. Asset recovery efforts traced funds to luxury properties, political donations, and venture deals scattered across jurisdictions. Billions have been clawed back, but the full extent of losses remains uncertain. For many, the courtroom reckoning revealed not just the scale of the misconduct, but the depth of the trust that had been betrayed. Today, billions in customer funds remain unrecovered, while global regulators scramble to fill the gaps FTX exposed. As crypto markets keep evolving, the line between innovation and oversight stands sharper than ever. Trust, once lost, is not easily rebuilt. In finance, transparency isn't just a promise, it is the only foundation that lasts. What safeguards would you demand before trusting your money to the next big thing? Share your thoughts below.